So good afternoon. I'm Kim Walker and I'm the director of the Women's Philanthropy Board, and thank you for joining us today. For those of you, well, I'm not going to go through my speech because all of y'all know right now what Women's Philanthropy Board is, everyone that's here with us right now. But we thank you for being with us. This is our 20th virtual program in our new normal. And if you've missed anything, we have uploaded most of our programs that we've done to our YouTube page if you want to go back sometime and watch them. And this one will also be uploaded in the next few days on there. And our YouTube account is just aub.ie/WPB YouTube. So please check that out and make sure that if you're on Facebook, following us on Facebook to find out when we have some new programs coming up. For the session today, if you have any questions, if you will just put those in the chat, and Barry and Greg will answer those at the end of the session. We are so proud to be partnering with Warren Averett for this event today. For those of you who do not know, Warren Averett provides traditional accounting services, technology resources, HR solutions, and business advisory needs. In addition, they provide personal services such as wealth management, estate and financial planning services, and daily money management. And we're thrilled to have Greg and Barry with us today. Warren Averett has been a longtime partner of the Women's Philanthropy Board, and we're just thrilled when they allow us to call on them for sessions like this. So Greg Sellers is a member in the tax division and a leader of the estate and trust service area for Warren Averett. He has more than 3 decades of experience in public accounting, specializing in estate, gift, and tax, trust tax planning and compliance. And he frequently presents on topics such as estate planning, retirement income planning, charitable gift planning, college savings plans, and collaboration among professional advisors. And Barry Prim is a senior client consultant for Warren Averett Asset Management, and he's responsible for building and strengthening client relationships and growing Warren Averett Asset Management in the Montgomery, Alabama area. And before he joined Warren Averett, he had experience including asset management, banking, client relationships management, and marketing. So thank you so much, Greg and Barry, for being with us today and for sharing your time and talents with us. And I'll turn it over to you.
Great. Thank you, Kim. We do appreciate the opportunity for Warren Averett and the Auburn Women's Philanthropy Board to collaborate together. Looking at the screen, I see some familiar faces and names, and thanks to all of you who are attending in spite of knowing me. And so Barry and I are going to do a little tag team presentation here. Barry told me just this week that neither one of us are at a loss for the ability to talk. And we certainly have a lot to talk about. So what we'll do is we're going to reserve the time for questions and answers at the end of the presentation. So in about 3:30, something like that, we should have time for some questions. But we will try to reserve time to be able to go over questions. And then if we have lots of empty space, we can fill it up with some more content. So let's go ahead and get started. One of my favorite sayings is that estate planning is a process and that's not a project. There are tasks that must be accomplished during a planning session or a planning process. You have to have wills drafted and signed, and the assets must be titled correctly, and maybe designating beneficiaries on retirement plans and life insurance policies. But an estate plan is really establishing a philosophical mindset, that mindset of determining what's important to you and how you wish to convey your legacy, a legacy that includes not only your tangible assets, but also one's values and philanthropic beliefs.
That's right. And one of the things that we would like to do today is a lot of the topics that we have are going to be at a pretty high level. We'll go into some detail, but we're not going to dive into minute detail unless the questions at the end of it sort of dictate that. Really, our goal today is to get you thinking about the estate planning process. You'd be surprised how many people don't think about it. And, Greg and I have been in this business a long time. And one of the things that we didn't mention is Greg has been on the CPA side of the estate planning business for most of his career. I've been on the administrative side of it. I actually started and ran an independent trust company for 10 years before I came to Warren Averett. So I've been involved in lots of estates. I'm going to share with you a little later on a couple that were challenges and might have been avoided had they been handled a little differently. But what we want to do is sort of outline the essentials that you need to do and to think about so that when that time comes, things will be handled the way you want them to be handled. Nobody likes thinking about passing. And everybody wants to try and control everything once they're gone. Our challenge today is to try and get you to think about some things that might be comfortable, while at the same time realizing that you can control some, but it's not necessarily in your best interest to control everything. The lesson my wife tries to get me to learn all the time. What I'd like to do is to start with some estate planning essentials. Okay, now Greg is going to kind of go into some more documents, but before we get into the document side of what you might need for your estate, I'd like to address first how that gets there. And one of the ways, and one of the things you need to think about is creating a team of advisors around you so that you can have the best expertise as you make these decisions. That team starts with a certain group of core people, and I'm going to name them, and then I'm going to give you some examples within them so you can think about who serves in that role. The first and probably one of the most important roles is an attorney. If you are going to draft a will, we highly, highly recommend that you get an attorney to do so. Now, attorneys are a lot like any other capacity, CPAs, investment people like me. Just because you have the title of attorney doesn't necessarily mean that you do a lot of estate planning. I happen to have some friends who are plaintiff lawyers. I would not go to them to ask them to draft me a will. An estate planning attorney is somebody who has sort of dedicated their career and read up on the case law so that they can deliver this sort of niche service within the attorney world. You've probably all got attorney friends, and they may be capable of doing something simple, but if you're going to have something that has any teeth to it at all, we strongly recommend that you find an attorney who has some estate planning experience. So position number one on the team, and these are all sort of interchangeable, but position number one on the team is an attorney, because they have to be the ones to draft the documents. Position number two is an accountant. And just like attorneys, accountants specialize in a variety of things. Greg Sellers happens, and I'm only saying this because I've used Greg outside of Warren Averett and before I came to Warren Averett. Greg Sellers happens to be the best estate planning CPA, in my opinion, in the Southeast. Greg has, over his career, accumulated a wealth of knowledge specific to this part of accounting. Somebody who does multiple things may not have the expertise or experience that Greg has. So when you decide to ask that next person on the team, you need to ask them what their experience is in this. The third part of this team is a financial advisor. And as you might guess, financial advisors can be very, very broad. In this world, you've seen all the commercials Anybody and their brother can claim to be a financial advisor. There are stockbrokers, there are financial planners, there are fiduciary managers, non-fiduciary managers. It can become very confusing. My recommendation is that you probably already have a financial advisor. You need to ask them whether or not they have any experience in the estate planning process, because it's important that they understand how your portfolio fits into this, because there are ways within asset management to structure and do things that fit into the plan. The last thing, and this is sort of and I'll address it a little more later on, but one of the other things that you need to think about to be a part of the team is who might serve as your executor and who might serve as your trustee. Now, I'm going to go into a little more detail about that after Greg kind of goes over some of the essential documents. But this role, who serves as your executor and your trustee, is very, very important, because that person needs to be qualified and understand the role they are taking on. So in short, all of these various roles make up the team that helps you get the planning done to do the things that you want to do. They're all important. You might already have a few of those, but for it to be effective, you really need to make sure that everybody understands their role and their expertise. Now, Greg, I think is going to talk to you about a little more specifically about some documents.
Thanks, Barry. Yeah, so as far as an estate plan goes, there are essential documents. We're not saying that all of them have to be utilized, but they need to be considered. And certainly the very first one that comes to mind to everyone, hopefully everyone, is the last will and testament. And so the last will and testament identifies who the maker of that will is. It'll many times identify family relationships. It'll appoint the executor or trustees. It provides very specifically the direction to the executor as to how they would like their estate administered. It gives that instruction how to convey the assets to the beneficiaries. Keeping in mind, however, that the will to be effective must be probated or recorded in the public records at the probate court if you're in Alabama. Other states may use other courts to do that, but keep in mind it's a public record. So there have been times that I've seen where individuals may have some matters in their family, whether it be descendants or some awkward circumstances where they don't necessarily want public record, everyone to know all the skeletons in their closet. And so, at least at a minimum, a simple will is necessary for everyone to have to get things started. To avoid some of the public record issues, many people will create what's called a revocable or a living trust. And that trust is a separate trust that's created during life. It can also be created at death, but that's a different story. These are created during your life, and it can serve as the conduit for all of your assets to go through for disposition without going through the probate process. So if it doesn't go through the probate process, you don't have public record so that you can keep those skeletons in your closet. And it also is not delayed. The probate period for the claims of creditors is 6 months in the state of Alabama. So once you probate, or your will is probated, your executor must wait 6 months after they've given notice to all of your creditors that so that those creditors could come to the court and say, this decedent owed me X dollars. The estate cannot be closed for at least 6 months following that period. A revocable or living trust doesn't have that time restraint. So the transfer of the assets to the beneficiaries can be accomplished many times much faster. Keep in mind too, don't let, if you don't create a will, the state of Alabama has underlying statutes so that if you died intestate, meaning without a will, they say how your assets would be divided up. And so I would urge people, though, not to let the state, now the state doesn't get the assets. Many people get confused about that. But the state statutes direct how the disposition of those assets will go. And so, for example, instead of, you might want everything to go to your surviving spouse. Well, that's not, if you didn't let you say that in a will, that's not how the statute, if you had children, for instance, minor children, it would put part of it to the surviving spouse and part of it for the benefit of the minor children. So the state statute, don't depend on the state statutes to dispose of your assets. While this revocable or living trust can serve in place of the will, you still need to have at least a basic will to catch anything that didn't get put in the trust during your life. And that's one of the keys to when you establish a revocable or living trust. You need to be diligent about titling everything in the name of the trust so that it actually performs the actions that you want it to happen. Otherwise, you're going to have to go through probate anyway to get it to the revocable trust. So the third document that's what we consider to be an essential document of estate planning is a healthcare directive. Many of you may have heard of it being referenced as a living will. The healthcare directive specifies the creator's desires for their healthcare decisions. They'll note in the healthcare directive whether they want to be provided food if they are unable to make medical decisions on their own. They'll indicate their needs or desires for food and water, life support. Now, there is the Alabama legislature has created a statutory healthcare directive. So you can actually go print it out and fill it in. Unfortunately, though, when you go to doctors and hospitals in particular, those hospitals don't always feel like they have a clear direction from those documents. And so they'll have their own format, which kind of defeats the purpose, in my mind, of having the healthcare directive if you have to be of sound mind to fill out their own directive. But in any event, don't be surprised if the healthcare directive that you or someone that may have appointed you their healthcare advisor, if you supply that to a hospital and they say, well, this doesn't meet our criteria. So it's good to have it, and it gives some guidance. It may not be followed exactly. In the healthcare directive, there's usually the appointment of a healthcare proxy. And the healthcare proxy is someone who carries out the medical decisions in the way that the individual would have carried them out. So that is the important part, the main important part of the healthcare directive, which is appointing someone else who stand in that place of that sick individual or hospitalized individual to make the decisions for them. Let's see, fourth, durable and general power of attorney. This essential document is fairly common. I think everyone probably knows that when they appoint someone as their power of attorney, they're allowing someone else to make decisions for them, business decisions for them typically. It provides for another person to sign and transact on that person's behalf. Keep in mind that the power of attorney, this is a common misperception, the power of attorney is only good during the life of that person who makes the power of attorney. It's not a substitute for will. So if you hold the power of attorney for someone during their life, you can transact on their behalf. The moment that they've passed away, that power of attorney is no longer valid. I believe, and I think most people should, the attorney in fact named as the power of attorney must be of the highest ethical character, because they will have access to that person's assets. So it needs to be someone you trust absolutely, and that person will have the best outlook for your own assets and your own benefit. One important fact about the power of attorney: it will not protect the maker from themselves. For example, the power of attorney can execute a document to buy or sell property, but the power of attorney may not prevent the maker of the power of attorney from transacting on their own behalf, writing a check that maybe they made a poor decision for writing a check, writing it for too much or cutting too many checks. So don't get confused and think that the power of attorney will actually prevent an individual from making poor decisions. Finally, it's not a legal document, but I believe the personal document locator is a very important document for everyone to have. I don't know about y'all. Hopefully you're a little better organized than I am, but I have a drawer here at my house that contains some information related to life insurance policies and homeowners policies and warranty information and automobile titles. And then I have another filing cabinet that's got tax returns and copies of wills and my essential documents. And then I have some things at my desk drawer in my office. And anyway, it's kind of scattered about. If you have one location for all of your information, that's great for you to have it all together. But who knows that you have it all together? Is your executor, is your surviving spouse, are they going to have to go hunting for it? And my point is, have a personal document locator, keep it up to date, and make sure that the people that you trust know about it, know where it is. Don't put it in your safe deposit box. Don't put your will in your safe deposit box. I can't tell you how many times that I've come across people who said, oh, well, that's in my safe deposit box. Well, if you die and someone else doesn't have the joint tenancy on the safe deposit box, you don't have access to the will to be able to go get it probated so that the executor can then go open the safe deposit box. So it's very, very important that you have clear directions as to where documents are located, and then clear access to them as well. I see one of the questions here is that do we have a sample of the document locator? And I do have that, and I will be glad to send it out. I'm going to send it to Kim following the presentation, and that way she can distribute it out to anyone who would ask for it. I see Barry's already answered that, and so thank you, Barry.
Yeah, you're welcome. You were talking so well, I didn't want to distract you. All right, just as a recap, because what Greg said was really important. The primary drivers for your estate plan are a will, that needs to be done, regardless of whether or not you think everything's simple or not. It really can help and does help to have a will. A healthcare directive, even though the hospitals may make you do another one, it makes sense to go ahead and get one done. A durable and a general power of attorney, although you must choose carefully who has that, and it does not invalidate you acting on your own. It could become helpful if you're incapacitated. And a personal document locator, like Greg has described. All of these items will be the documents that make up your estate plan. So you need to make sure that you have all of those and they're drafted correctly for you to accomplish your goals. What I want to do now, just for a brief bit, is what I'd like to do is dig a little deeper and talk a little more specifically about how these documents get applied. Specifically, in your name, when you create a will, or if you create a trust under a will, or if you create a revocable living trust, you have to name a trustee. And in your will, you have to name an executor. The executor is a fancy word for saying that's the person who follows the terms of the will, and then when the estate is finished, closes it out. In some states, it's called an administrator. We know it as an executor. In Alabama, it's typically called an executor. A trustee, in a similar fashion, their job is to follow the dictates of the trust. Now, trusts don't always have a finite life. They are not allowed to go in perpetuity, but they can go for a very long time. So a trustee may be agreeing to serve for a long time, whereas an executor typically serves for a very finite time. But both of these roles, and having been in this business for 30 years, both of these roles are typically named by friends and family. That is what we see most of the time. In simple wills, the spouses normally name each other. If there's not a spouse, a lot of times it's a friend. Sometimes they'll name a friend as a trustee. Sometimes they'll name their attorney as a trustee. While that can work and does work, there are many instances where it will not work. The things that I want to get you to think about today, and I'm going to just mention a few of the responsibilities, and I'm going to give you two case studies, two very brief case studies of real trusts in a real estate that I've handled in my life, that where I was hamstrung by the way the document was worded. But first, let me tell you what you've got to think about when somebody is named as your executor or your trustee. Number one, the trustee has to understand the role they are taking on, because the role of a trustee is a responsibility, and it includes work. And it is an honor to be named, but it is not something that you can just be named and then expect to do nothing, because there is work involved. And so if you name somebody, you need to understand and make sure they understand that they're willing to put in that work to do that. The second thing, you need to make sure that they're able to serve. One of the most common things that we see is somebody in their 50s names their best friend as the executor, and they don't die until their 80s, and the one in their 80s is not able to serve. So you need to be able to think through a succession of people who can serve if somebody is unable to serve in that role. The person who serves in this role needs to be able to understand that there might be conflict in this role. And they need to be able to sometimes negotiate this conflict. There are a lot of people who are fantastic human beings who hate conflict. And if you ask them to serve as executor, and cousin A and cousin C are arguing, they don't want anything to do with having to get in the middle of those family dynamics. While it seemed like a good idea to ask that person because they're so nice and so charitable and so sweet, you're actually doing them a disservice to ask them to serve in a role where they're not comfortable negotiating those things. So this person really needs to understand that they may be called upon to be a referee at times, because I've been there. And that's not always the funnest role to be a referee, but it can be done if the right personality is put into the role. The other thing, there are a few basic tenets to being an executor, to being a trustee, that all of them share. One of those is they have to have a duty to inform. They have to have a duty to report all of their transactions. So a trustee and executor have to be totally transparent in this role. They have to be prepared to produce reports. As an executor, when you close the estate, as a trustee, as an ongoing measure, you have to report all the transactions that occur. They also have duties typically to diversify. We see this a lot. We see a person has a business, a closely held business, and they don't recognize that if they leave it in trust and they don't put specific language that absolves the trustee of that, it is just generic, the trustee has a duty to diversify. A little drafting can fix that, but if it's not in there, the trustee is going to be put in an awkward spot. The trustee also has to make decisions that factor in all prevailing economic conditions. And so it's a role where you have to think beyond just yourself. Part of the reason why you have to think just beyond yourself, especially in the case of a trustee, is because a trustee gets charged with having a dual mandate. Most trusts are created with two parties involved. There's three total. One is the trustee, and is the current income beneficiary or principal beneficiary. And then the third party is who gets the trust when the income beneficiary goes away. So a trustee has this dual mandate of it has to provide for the current beneficiary, but at the same time, it has to keep in mind that there is somebody who will inherit this trust when it stops. Those two parties do not always agree with how that trust should be managed. For example, if I need all the income I can get and I'm an income beneficiary and I want the trustee to buy all junk bonds that are paying 7% or 8% or 10%, but yet the remainderman who might not get it for 30 years want some growth in the portfolio. You can see where as a trustee, I might be conflicted as to what to buy. Do I meet all the needs of this person or do I meet all the needs of this person? So the trustee has this role to balance these things. And if you pick the wrong person to be in that role, what can happen is eventual litigation. And you want to avoid that if at all possible. So if I'm scaring you a little bit, I'm sorry about that. That's what I'm trying to do. You want to pick somebody that knows what they're doing to put in this role. A flip to that, if you don't have an individual, you can always name a corporate executor or a corporate trustee. There are businesses that do this for a living. Warren Averett is not one of those businesses. I did have a business that did that. Used to be called Alitrust. Doesn't exist anymore. But our job was a named corporate fiduciary, and we did it for a fee. That is the trade-off. Typically, if you ask Cousin Joe or Aunt Doris to do this for you, they're not going to charge you a fee. A corporate fiduciary will charge you a fee. But what you get for that fee is all of the things that I just described. Plus, you get the continuity of knowing that organization will continue to exist in the future. And you might not have a situation where a trustee passes away or refuses to serve. So if you want information about corporate trustees, we'd be happy to give that to you offline. and give you the names of a few to talk to if you get put into that situation. Now, briefly, because like Greg said, I know I talk too much. Briefly, I want to give you two examples of situations where the document was drafted incorrectly, and then the other one is where they picked the wrong executor. And I'm going to do these very, very briefly. I'm not going to give you names, and I'm going to change the circumstances a tad so you're not out there guessing who this is. These are not located anywhere near Auburn or really anywhere in the Southeast. Well, they're in the Southeast, but they're nowhere near here. Here's the first one. In the 1950s, I had just started at Regions Bank, by the way, in the trust department in 1990, and I had this trust. This trust was under my care. In the 1950s, a doctor had created a trust for his daughter. He was in his 60s. His daughter was in her late 20s. At the time, did not have children. The document was very, very specific, and it was funded with a fair amount of money. And the document said that during her lifetime, she could get $400 per month. That's it. She could get $400 per month. There was no encroachment provisions for her to get to the principal in any circumstance. $400 per month. For her death, it was to stay in trust for her children, and if her children predeceased her, it was to go to her grandchildren if she ever had them. So fast forward 20 years, and you're now in the 70s. She's had kids, and she has grandchildren that are just being born. Fast forward another 20 years, Barry comes into the picture. Her children are gone. Her grandchildren are alive, but they are ostracized, and they do not get along. The income beneficiary becomes sick, gravely ill. She has a medical treatment that can help her and save her. This trust, which has been providing this for her during her whole life, has now grown into millions of dollars because it was fairly easy to meet that goal. Unfortunately, the document would not allow us to give her any help whatsoever for the medical treatments. We, as corporate trustee, were very frustrated by that. So we go to the remaindermen, the grandchildren, and ask, can we go to court, get the court to rule on a modification to this trust to a certain limit to help your grandmother? They refused. So we go to court, and the court won't hear it because the remaindermen refused to do it. So we're back at square one. She did not get the treatment that she needed. All that document needed was two things. Somebody needed to tell the person who drafted it, let's not be that specific to the amount, because circumstances can and will change in a 40-year period. $400 in the 50s is not $400 in the 90s. That's an easy drafting solution. The second thing that you would ask if you're doing this is there should be broader language that allows the trustee the ability to have the flexibility to make a decision to help her. We would have easily consulted the beneficiaries, but given the ability to make that, we would have helped her, but we could not. So that's case number one. If you get the right estate, as much as you want to be specific with the language, follow the advice of a good estate planning attorney and allow it to not be as specific as you think you might need. At least give the trustee the ability to make some room. Case number two, and I'll be real quick about it. We had an estate, a very, very large estate. The only asset in the state was an extremely successful, closely held business. Okay? This closely held business was run by what I'll call the grand man, because that's what he called himself. It was run by the grand man, and the company was run by the grand man in a very loose kind of way. He spent money. He was successful enough that he could do this, but he spent money on he and his family lavishly. He would take company assets and he would pull it out and buy fur coats and take trips around the world. He did all these things as the owner of the business. He named as the executor of his estate his number 2 person at the company. Logical choice, because the company is the asset. Ultimately, though, the beneficiaries of the estate were not the person running the company. It was his daughter and son who were not involved in the business. They stood to inherit the business. Fast forward 6 months into the administration of the estate, and the number 2 guy, who is now the CEO and executor, is running the company exactly as his mentor had run the company. He's buying his wife fur coats. He's taking trips around the world. He's using these company assets, pulling money out to do all the things that his boss did. What he failed to realize is that the role of executor is different than the role of a CEO, because now he has to answer to the people who ultimately inherit the company, who did not appreciate him buying fur coats and taking trips around the world. So fast forward, it goes to litigation. He loses. He gets replaced by another executor who promptly does the same thing, and it goes to court again. We get called in as the third executor to this estate, and all of this could have been solved early on had somebody sat down with the self-named grand man and said, please do not name somebody who is this close to the business. You need to name a corporate fiduciary who will recognize the duality of their roles and not steer this estate into a ditch. Because what ended up happening was all of these assets that he had worked his whole life for got paid out to attorneys left and right. And so when it finally got to the end, that estate was half of what it was worth, and you had some really rich attorneys. And so I don't think that's what the grand man intended. So you really, really need to think long and hard about who you put in these roles, because I promise you it can go wrong. It can go right. I don't want you to hear me say that all of these don't go. I've seen plenty of people do this professionally and well done. It can work really well. You just need to think through and make sure they're ready to do this. Okay? So one other thing, and then I'm going to let two other things. I'm going to let Greg go into after that a little bit more on taxation. There are a couple of things that I need you to think about when you think about all these documents. One of the quickest ways to mess up a terrific estate plan is to forget to do the beneficiary designations and to forget to do all of the things you need to do to make that estate plan work. Two things that we see happen all the time is that a lot of assets are in an IRA and you forget to name a designation, a beneficiary. You name the estate as the beneficiary, or you name the wrong beneficiaries. It's very important that you review that. Another thing that we see all the time, especially for people who may have an estate tax issue, is they own everything jointly with right of survivorship, when in reality they might have needed to separate those during their lifetime to make use of estate tax exemptions. So you need to think and use your team. Go back to what I said at the beginning. Use your team to think through how are all of these assets passing. When Greg provides you this list, you need to look and double and triple check to make sure that all of the accounts you have are titled correctly and have beneficiaries named correctly. Okay? I can't stress that enough. Do not rely just on one member of the team to do that. You need to do it too. Double check that. The last thing that I want you to think about, and this is kind of new to everybody, is now we all have digital assets. You don't think of them as assets, but your Facebook account, if you have a Google storage account, if you have an Amazon account that has a credit card on it, all of these different digital assets for this new digital life we have a life of their own. When you pass, nobody instantly tells Amazon to turn off that credit card, and they don't know. So you need to make a list of all of those, your digital life, of what those accounts are, what the passwords are, what credit cards they're tied to, so that your executor, because there is a process at Facebook, Instagram, Twitter, Amazon, believe it or not, they have an actual process that you have to go through. The executor needs to know all of that information so that they can go in and get those things shut down for you. Okay? That's sort of a new twist to this deal, but it is something that you need to think about. Sorry, Greg, I took too long. So you roll on. You hit the taxes.
We warned you that we both like to talk, and you know it's evident when you're passionate about something. You tell everything. You want to make sure that everyone understands. So one of the things that we've talked a lot, but we hadn't said a word about taxes. So I'm going to hit briefly taxes. You've all heard that the only certainty in life is death and taxes. I'm sorry, are. My grammar teacher would have just killed me just then. The only certainties in life are death and taxes. I don't think that taxes end at death. So we're going to talk a little bit here about income taxes. So the executor of a will, in conjunction with a surviving spouse, if there is one, must file an individual income tax return for the decedent in the year that they die. So got somebody that passes away, let's say June the 15th, and so they were alive for 5.5 months in that current year. So they have to file a tax return. It's the executor's responsibility. The decedent didn't get a chance to do it before he died. Likewise, many people don't really think about it, but the estate is a separate tax-paying entity then. So after death, all income reporting responsibility for the individual that died stops at their date of death. But the estate becomes the new entity, the new taxpayer. And so the executor or trustee, depending on the way it's structured, but the executor of the estate is required to then start filing an income tax return for the benefit of the estate. It's not a 1040 like we all file as living human beings, but the estate's income tax returns a 1041. It's a little bit different. I tell people it's not rocket science because I do it, but it is different, and very few people really dig in and study it the way it needs to be done. The estate's fiduciary income tax return discloses the income earned by the decedent's assets, and then some disbursements from the estate are allowed as deductions, which can reduce the taxable income of the estate or reduces the taxable income that flows out to the beneficiaries. We don't have enough time to cover all of the aspects of fiduciary income taxation, but just know that the estate is a taxable entity and is required to file an income tax return. Then we get into wealth transfer taxes that are associated with estates. Wealth transfer means exactly that. Someone is moving wealth from themselves to another person or to another entity. Federal gift tax returns report the transfers that are made during life. For the taxation of gifts, if the transfer exceeds $15,000 per recipient during the year, the gift tax return is required to be filed, even though the lifetime exemption shelters and keeps the individual, the donor, from paying a tax. That's another often overlooked component where people think, well, I don't owe any gift tax. I didn't give more than my lifetime exemption. It's still disclosed in the report or in the filing of the return, and that return is required to be filed. Now everyone's heard of the federal estate tax return. That's some people refer to it as a death tax. It's the estate tax. It's the tax that's assessed on the net worth of the decedent and calculated by the assets that are owned or controlled by the decedent at the date of death. I say owned or controlled because the decedent may actually not own some of the assets any longer, but they can control to whom the asset is given. Okay, and that control still causes inclusion in their taxable estate. Also, keep in mind that accumulated taxable lifetime gifts that have been made prior to death are added back to the assets that are owned at death to then calculate the total estate on which the estate tax is calculated. Some states, like New York or California or some other states, there's a few now. There's not as many as there used to be, but there are a few now, assess their own estate tax. So even if you don't have a federal estate tax filing responsibility, you may have the executor may have a filing responsibility in particular estates where they have their own estate tax. Generation skipping tax, that's something that some people may not have heard about. That's if you make a transfer either during life or at death to a skip generation, a grandchild generation, a great nephew or niece generation, or if it's an unrelated person that's more than 37 and a half years younger than the decedent, they are making a generation skip. So the IRS has said, not only do you owe an estate tax on the assets that you may owe in excess of the exemption, if you make it to a skip generation, you owe an additional tax. Currently, both of those taxes are at the 40% rate. So in theory, if you have a taxable gift that winds up exceeding your exemptions, both for federal estate tax and generation skipping, you could owe, okay, get this, 40% estate tax and 40% GST tax on that $1. Okay, you get $1 out, 80 cents of it's going in taxes. Pretty onerous. You may also hear of an inheritance tax. Alabama doesn't have an inheritance tax, but that tax is assessed on the inheritor of the assets. So let's talk a little bit about the current estate tax law. This current law became law at the very tail end of 2017 for years 2018, 19, and this law will what's called sunset. It will go away in the year 2025 unless changes to the law occur. The lifetime exemption under that law for 2020, okay, for decedents dying in 2020, is $15,580,000. And I'm sorry, I just gave you 11. It's 11 million. My notes I put 15. It's 11,580,000, and 2021 is 11,700,000. The exempt amount is indexed each year for inflation. The tax rate is currently 40% for any dollars or value that exceeds the exempt amount of 11,580. And then there's also a component of the estate tax that allows us to make an election to transfer the deceased spouse in a married couple, the deceased spouse unused exemption. For example, two spouses never used their exemption. They each have 11,580,000, and if they own assets and they shift all of their assets over to the surviving spouse, then you can also file a return, make the election to transfer the unused exemption amount of the first to die to the second to die, so that the second to die would then wind up with $22 million or $23 million in exemption. That is in the current law. And you'll notice, and I'll talk about it in just a few minutes, I'm really emphasizing the current law. Income tax basis adjustments are allowed at date of death. So at the death of the individual, the new tax basis in the assets that individual owned changes from what may have been low tax basis up to the fair market value at date of death. And then also automatically the assets get a long-term holding period. That's pretty important. So let's say that the decedent acquired 2 months before they died an asset that they've only owned for two months. Immediately upon their death, in addition to the tax basis they also get an automatic long-term holding period. That's beneficial to those who inherit that asset, because then it would qualify for a long-term capital gain upon disposition as opposed to a short-term capital gain. Finally, under the current law, as I mentioned, it lasts until the year 2025. And in 2025, the $11.5 million exemption will revert back to a $5 million plus some indexing level if the law's not changed. So we already know, current law, that's going to go away, and we're going to get half as much exemption for people who die after 2025 as they would if they died before 2025. Now, we are getting close to time, I know, but I do want to point out real quick. You may have realized that there was something big that happened a week ago. There was an election, and when we scheduled this, we said, oh, won't it be great to schedule this after the election, so we'll know what have a good idea what the tax laws or changes might be. I did not anticipate at that time that it was going to be the weekend before we had any sense of who the succeeding president would be, or that it would still be up in the air as far as decisions made on who the Senate seats are. So I can't really get into a whole lot of details. Matter of fact, I have a feeling some of my colleagues that were making some presentations today also, they probably feel like I do. I don't really know a whole lot more than we did a few days ago or a few weeks ago. I do have a sense, though, what Biden has said that he would like to do if he could get his way. So that's kind of still up in the air, because if he's got a split legislature, might not be an easy route to be able to change the laws. But it is possible, certainly. Biden proposed from the estate taxes that we go back to the law that was in place in 2009. So I barely even remember 2009. That was so long ago, especially in COVID times. What the exemption was in 2009 was $3.5 million and a 45% tax rate. And so think about it. We're at $11.5 million. If he got his way, the exemption would only be $3.5 million. That's an $8 million spread that for people that may have between 3.5 and 11.5 million, that's a big cut in their estate. Also, another big factor that I didn't initially think about was we've gotten so accustomed to the exemption being available for lifetime gifts and estate tax exemption. But in 2009, there was a cap on the lifetime gifts exemption at $1 million. So if we're, 2020, current law, you can give away $11.5 million of your assets and not pay any gift tax. But if we go back to the 2009 rules, the only amount you can give away without paying a gift tax is $1 million. That's another $10 million spread in there where taxes could occur. Biden is also a proponent of no income tax basis adjustment. I mentioned when you die, the basis then adjusts to fair market value. So let's think about that. Decedent bought Apple stock back in the 80s at $10 a share, and now it's been split up a gazillion times, and it's worth whatever it's worth today. Many times. That income tax basis is what he originally paid for it. Under the current law, if you die with it, it gets a new tax basis equal to what it's worth on the date of death. Under Biden's favor, he doesn't like the income tax adjustment. So basically, the beneficiaries of the estate would wind up being burdened with an income tax on all that appreciation that would have occurred between the original purchase and the date of death. Excuse me. He's also suggested, this one's onerous to me, also suggested that death would be a triggering event for capital gains. So not only would you not get a step up in basis, but death would cause a capital gains tax to be owed by the estate. Essentially a death tax on unliquidated assets. That one's going to be hard to pass, I think, because if you would be forced to liquidate. And I don't think that's the intent. So 104, we hit it an hour. We will take questions, absolutely. And I'm happy, Barry and I are happy to sit here and answer some questions. So are there any questions at this time? I only have another hour and a half of material if y'all want to go through that.
You think he's kidding?
Any questions?
We need to have a part 2.
A part 2.
Maybe.
Maybe we would know more for a part 2 in a time later. Yeah.
We might know where it's headed.
Yeah. Well, we are happy. So if you have questions, please feel free to reach out to Barry or me. We are more than happy to answer any of your questions. We do look forward to having another opportunity. We hope that we haven't bored you all silly. And so please reach out to us. Please invite us back. You can tell we love to talk. We'll be glad to talk.
Well, y'all put your emails in the chat for anybody who might want to contact you directly, if that's okay with y'all.
Sure, of course. Greg, you want to do that?
We'll do it.
You got that?
I got it. I'll put both yours and mine, and I'll let you wrap us out.
Yeah. First of all, let me thank you. I appreciate everybody coming on the call and taking an hour out of your day. That's a good question. I'll let Greg answer that. He's the tax expert, Sid. I really do appreciate y'all taking the time. Remember, our goal was not to make you an expert. Our goal was to make you think about it. And so hopefully we've done that. Keep in mind, assembling a team is the key here. Reviewing your documents to make sure and getting them to review your documents, that's the key. And then executing. So if at the very least we've got you worried about it a tad, and you do something about it, then we've been successful. So, we're always here offline to ask any complicated questions. Those will all go to Greg because he's the complicated, smart guy out of the group. So, but we really do consider it an honor to even be asked. So we appreciate it and love to serve if you have any questions.
Hey,
Greg, you had a question?
Yeah, can I pipe in here first, though, before my question is answered? Thank you guys very much. Thank you very, very much. That was great. And maybe we'll do a 2.0, I don't know, maybe in January, Feb, because we might have clarity on what's coming down in the pipeline,
Okay.
I'll be happy to. And to answer your question, Sid, so remember the new administration really doesn't even come into office until whatever it is, third week in January. We might not even know who the winner of the Georgia runoff would be. So we really don't even know how that would look. I really don't believe, even if this was the highest priority in the new administration, you remember they talk about the first 100 days typically, and they may have it in that first 100 days. That's 3 or 4 months. So I'm thinking that earliest we'd be looking at would be mid-year, more likely even late year, as again, mid-year they will be more interested in vacation recess and things like that. So yeah, it's not something that's going to take place immediately, but keep in mind they could pass laws that would be retroactive to the beginning of the year. And so I think we just have to be prepared. So from a planning standpoint, the urgency tends to be right now, get it done before December 31.
Yes. The other thing I would add to that is it really depends on the Senate. If the Senate swings 51 votes to the Republican side, I can't imagine anything will pass. None of those plans that he wants to do will pass. The other caveat to that is even a Democrat who believes in this higher taxation will not do it in a recession. So if we're still continuing to have pandemic problems, I would imagine that ball will be kicked until we're out of that and in the clear. And I'm not weighing if it's good or bad. I'm just saying, practically speaking, I don't think they would do that if we're still in a recession.
I think that last tax bill was passed in April of that year.
It was.
And it was priority, number one. And, priority, it seems now, is dealing with pandemic and economic recovery. But I think Greg's point is very astute, that any new tax laws could be retroactive back to whenever the administration changes.
Probably would be.
So to Barry's point, run, don't walk to get it done.
And also keep in mind, some of the policies that have been implemented or pushed off in tax, so the way taxes are, have been through president or executive order. So for instance, there were some proposed regulations related to valuations and treatment of certain estate planning strategies that were on the verge of being passed right before Trump was elected. And I think the first day, he issued some executive orders to prevent those IRS regulations from passing, which would have made some really significant changes to how closely held assets were being valued and the terms of grants and some of these other estate planning vehicles. So Biden's already said that some of the executive orders that President Trump had passed, he will reverse. And so believe, and I think that some of the others who have studied this feel like some of those things that got quote unquote back burnered and pushed off will be back on the front burner sooner than later. It doesn't require legislative change.
Yeah.
Well, again, thank y'all. Kim, we
Thank you.
appreciate it.
It's great. Enjoyed it. Slightly scared. A
Don't
little
be scared.
overwhelmed.
Thank
It was
you so
great.
much,
Thank you
Greg
so
and
much.
Barry.
You're welcome. We're big believers in the Women's Philanthropy Board. We appreciate everything y'all do. Y'all are a fantastic organization. Warren Averett totally supports everything you do. I hate that I didn't get to go to the big dinner. I know it was virtual this time around, but I love those things, seeing everybody. So I'm ready for that to be back to normal.
Thanks. Well, we have a real proud point with you guys in that you're now, is it managing partner?
That's correct. Managing member here in Montgomery.
Managing member. Sandy Coker is the former WPB president.
That's correct. That's right. Yep. Proud former president.
Yeah, she's great. Please send her warmest regards.
We will. We will.
Thank y'all.
Thanks again.
Okay, thanks everybody. Great to see everybody. Thanks a million, Greg and Barry. Really appreciate
Bye-bye.
it.
All right. Bye-bye.
Bye-bye.